Hi guys, so let's take a look at the balance payments. Now this is a really important concept that you need to get a really good understanding of. Often I find that it's covered in a huge amount of detail in class, but that doesn't correlate to a really good understanding and the ability of students to actually analyse and evaluate. For instance, there's no point in just being able to regurgitate knowledge on this. What's more important is that you truly understand it and truly understand what it shows, why there can be problems within it, and the significance of it for an economy. Okay, so let's take a look. So the balance of payments is a record of a country's transactions with the rest of the world. So it shows us how trade flows are actually occurring and to what extent. In addition to that, it tells us about net investment income flows that are taking place. And in addition to that, we'll also understand investment flows into portfolio investments such as stocks, shares, equities, as well as bonds, government and corporate bonds, so company-based bonds. And finally, it may also help us to understand what is taking place within the realms of foreign direct investment, inward and outward. Okay, so let's take a look. So the current account, firstly, is one of the crucial components, and you will generate a very, very good understanding of the current account and its significance. So this calculates, firstly, the trade in goods and services. That is our trade balance. So this shows us our trade balance, okay? Of course, goods are visible goods, visible items. Services are regarded as invisibles. So we could therefore within that have the visible balance and the invisible balance, okay? So services, great example there would be tourism as an instance. Okay, together with net primary and secondary investment incomes. So examples of primary investment incomes would be perhaps UK earnings from direct and portfolio investments. So that is if UK companies bought a company abroad, the actual profits that are being repatriated to the UK would be reflected within the current account. In addition to that, interest earned or dividends earned from shareholdings overseas when they are repatriated back to the UK, again that would show up on the current account. And for the secondary income, investment incomes, well, a good example here could be about government transfers that are taking place. A great example within that bracket is perhaps foreign aid and foreign aid payments that are taking place. Okay, so that's our current account, something that we will focus a lot of detail on throughout the course. Then we've got our capital and financial account. So the capital and financial account records the actual investments abroad and foreign investment in the UK. Okay, so it records what investment flows are actually taking place. And this is portfolio investment. So this is investment in shares and equities, as well as investment in corporate and government bonds within a given country, and may also incorporate some complex financial investments in derivatives or swap options and so on. But further to that, we will also see direct foreign investment, foreign direct investment. That is investment, long-term investment into buying companies or buying land to actually build stores or factories within. Okay, so that will show up on the capital and financial account. Okay. And finally, we've got a balancing item within the balance payments. And this balancing item really helps us to understand any errors and omissions that are taking place within the balance payments to ensure ultimately that it balances. Okay, so those are the key principles that you really need to understand there, together with some good examples of the constituent parts for each of these elements here. Okay, I just want to show you and finish off by giving you an example of why the balance payments balances. And so we're going to simplify this and really break this down for a two-country based world. Okay, so imagining two countries, the UK and Germany. So in this two-country world, we've got the current account and we've got the capital account. Now I'm simplifying that further by just looking at exports and imports on the current account. So I'm just ignoring the net investment incomes element here. And again, for Germany, we've got exports and we've got imports. Then we've got our capital and financial account, and we've got inflows of capital and outflows of capital, and inflows of capital and outflows of capital for Germany. Okay, now of course the German economy is regarded and renowned for its current account surplus that it runs. Often double-digit surplus, so often 10% of the size of the German economy. Absolutely huge current account surplus that they run. Of course, one of the primary reasons for that is because they export far more than they import. So for the UK, for the German economy, exports are far greater in value than the value of the imports. Okay, for the UK economy, well, we export a lot of goods from Germany, of course, but we import far less to them. So as a direct consequence, it means that our imports are less than our exports. So for Germany, we can see that they would be regarded as running a surplus here. Okay, so they are exporting lots and lots of goods to the UK economy. We are importing lots of goods. The Germans are receiving British pounds in return for the products that they are selling us, and so they run a surplus, meaning that they have a positive value on their current account. Meanwhile, we can see that we have money leaving our country in return for German goods, and so therefore we are running a deficit. Okay, so what does this mean? Well, what this shows is that Germany is now accumulating a lot of cash, a lot of British cash here. Okay, so a lot of British pounds are being amassed within the German economy via that current account surplus that they are running. So what will they do with that cash that they now hold? Well, they could use it as foreign exchange reserves, or perhaps, okay, but they will also want to actually invest that money. So they will want to invest that money overseas. So where can they invest? Well, we've got two countries within this world, so therefore they are going to invest the British pounds back to the UK, and it's going to mean for the UK economy the inflows of money and investments will be greater than the outflows. But for the German economy, we can see the outflows will be greater than the inflows. Okay, so while we run a deficit here, we can see that we also, the UK economy runs a surplus on the capital account. So while Germany runs a deficit on the current account, a surplus on the current account, we can see that they will run a capital account deficit. That is, the outflows of investments will be greater than their inflows of foreign investments. Okay, so hopefully this nice simple example helps you to understand why the balance payments actually balances. Now, over time, what's also interesting here is because, of course, the German economy is sending a lot of capital to the UK and buying a lot of British-based assets. That is also likely to be increasing in the future their net primary investment income. So that would further reinforce their current account position. Okay. So when you run a deficit on one of these accounts, okay, you will run a surplus on the other, hence the balance payments balances. Okay, thanks guys.